Good day, and welcome to today's episode of Entrepreneur and Enterprise Development Series. Now, this is a podcast that informs you on anything entrepreneurship. My name is Podiso Mudirwa, and I'm here with Mr. Moemedi Senwelo. We are going to be talking today about handling business money. Senwelo, welcome.
Thank you, Podiso.
Yeah, so I want you to speak about the business as a separate legal entity. What does that mean?
In accounting, there is a term called business entity concept, which means the owner and the business are two separate entities, meaning that the owner's personal transactions should be separate from the business transactions. That is, the two entities, even if the person is alone, running the business alone, no other partner, no shareholder, they should have a business account and they should have a personal account, and they should have their own salary where it goes to the personal account, and all the expenses, all the transactions should be made from the personal account, not from the business account. Because many a times, business people, business owners, they treat the business account like a personal account. You'll find personal expenses appearing in the business bank statement, and that doesn't reflect good on the business. And even when we are looking into potential investors and we are looking at financiers, as they go through that, it doesn't impress them. It doesn't show you as a person who has discipline to respect business money. So it really takes away your credibility in terms of qualifying for financing, for funding, for business expansion.
Well, that's interesting. You talk about business money. How important is a budget when you're dealing with business money?
A budget, as we know, it's a financial plan. It's how the business resources are going to be allocated to the expenses, to operations, to management. So really, a budget gives us an idea of how much we expect to make as a business, and how much of it are we going to allocate to different things that needs to keep the business running. That is why it's important to have yearly budgets, to have monthly budgets, so that we don't run our businesses on assumptions. We actually run it on the actuality of what we are receiving or what we are expecting to receive against what we are actually paying. Because if we don't have that in place, we will find that the business maybe is running at a loss and we are not aware of it. We just keep on putting more money in the terms of capital, or we just keep on running at a loss or running in credit on debt, you know. But when we have a budget, it will show us clearly how much we need to operate this business, and we'll be able to be disciplined more in terms of not having many unbudgeted spendings. Because some of there is, you'll find that a business is making a lot of money, it's making very good money, but then because there is no budget, you'll pay your main expenses, the salaries, the rentals, and everything, and then there are other things that come on the way which are not important, which are not urgent, which you can do without, but you keep on prioritizing, and in the end of the day, there is no progress because there's nothing to guide you, there's nothing to direct you, there's no measure of discipline in place.
Okay. I also heard you talk about a bank statement, which then suggests something to deal with bank accounts. Can you talk about the different bank accounts that are there for businesses or that one would consider opening for that business?
Yes. There are three types of accounts that I'm gonna mention or talk about, which I also recommend for every business. The first one being the common one, which is the current account, commonly also known as the transactional account. That's where you receive all your income, you receive anything that you receive it there. Then also you make payments out of it. You pay rentals, salaries, bills, everything comes from there. So that's why it's referred to as a transaction. All transactions take place in that account, and almost every business has it, or every business that has an account has it. That is the first one to start with. From there, there's another type of an account, which is called the call account. I refer to as the emergency account, because really that's the purpose why I would open it for a business to have it as an emergency or a backup account where I put a certain percentage of the business income to say if there's an emergency, if there's a shortage somewhere, we can always go to that account, because that account you don't need any notice. You don't need to wait for a certain period of time to access the money there. You just, anytime you walk into the bank and you can get it, or you can transact online and get the money from it and take it to a case where it's really an emergency, not something that looks like an emergency, but really an emergency where you really, is a matter of life and death for the business, then that's when you can access it. And then the third type of account, it's a fixed savings account. Really, every business should have a fixed account, either 6 months, 12 months, or whatever period that you can manage, because a fixed account enables you to save for investments. You save for future. I call it an investment account because it allows you to save for the future, that if you have a project that you want to work on, you can be putting aside a certain percentage of your income. And in the future, when you have accumulated a certain amount, you can be able to afford to purchase some assets. You can be able to afford to expand your business. Because if you are going to be working with a transactional account only, it means everything that comes in, it goes out, because that's how a transactional account works. It's money in, money out. But if you have a fixed account, and they say it's 12 months, you can't touch that money for 12 months. If they say it's 24 months, you can't touch that money for that period. So that's the advantage of having these three accounts, and knowing that each one has a purpose, each one has a function, each one is beneficial to the company.
So does that mean the call account is more dependent on just your discipline as a business or a person, since
Yeah,
there's no like limit particularly?
definitely it is dependent on your discipline, because some people have done that. They would open a call account, put money aside, and then the following day they go and withdraw it. It's the same as, if you have a personal savings account which has a card. When you run out of electricity, you can immediately go and buy electricity with the personal card, or you can go and buy food. Like your grocery has run out during the month, you go and buy food. So it really depends on the individual.
Okay. All right. I think next I'd like for you to talk about a cash flow in the business, what it is, and anything that you can talk about relating to that.
Cash flow, like Robert Kiyosaki in his book, he says cash flow is the lifeblood of the business. Just like we know there's blood in the body, it is the one that makes the body to be functional. It moves things around the body. It is the cash flow that is the lifeblood of the business, that with no money, with no cash flow, with no money coming in, there is no business. That is one of the biggest priorities of a business, to look into the management of its cash flow. How is money going in and how is money going out? So looking into the cash flow, there are two scenarios of cash flows. We have what we call positive cash flows. A positive cash flow is whereby a business makes more than what it spends. So that means at the end of the day, at the end of the month, there's a surplus. There's more money remaining in the account after having paid off everything that is needed to be paid by the business to operate. And then there's what we call a negative cash flow, whereby the business doesn't make enough to cover its monthly payments. So as someone comes into a business situation, when you are looking at your business, you have to come to a point where you analyze your cash flow to say, am I making a surplus, which is a positive cash flow, or am I making a deficit? Because that is very important, that at the end of every month, there should be a positive that you are making, and your bank balance has to be having a growing minimum balance, because your cash flow, every month you are receiving income and spending and remaining with something which is adding to the bank balance, that ultimately your bank balance keeps on growing and growing.
Okay, I'm talking about money and just like we said, discipline that you need to have as a business owner. How important would you say it is to have a financial advisor? Because I'm guessing not everyone knows how to maybe draw up financial plans or, understand how they can manage their money as it comes in and goes out. Would you say having a financial advisor is important, and don't those come expensive?
It is important, and talking about the part of whether it's expensive, it is expensive, but I would say it's worth it because the cost of not of making decisions alone and probably making a wrong decision financially are more than the amount that you can spend in hiring a financial advisor. Because a financial advisor will be someone who has experience either as a in management level or in helping businesses start up and run, that they can analyze your idea and what you want to do and be able to advise you whether that is a feasible idea which will cost you all your money or almost all your money, or whether not to do that idea. So it's important to get that feedback, especially when you are new in business, you're a startup. If you just find an advisor, and you don't necessarily have to always pay for the service of a financial advisor. If you find someone who is experienced in business, someone who has run a business for some years and they have succeeded in running a business. It might be a shop, maybe a transport business, just any business that someone you see this person has had maybe 5 years, 10 years in the industry, and they should be having an idea of how to manage money if they have stayed that long in that business. So you can start with that person. You ask them, can you be my mentor? Can you help me with my business finances? Every time when I make business decision, can I come and sit down with you and we look at the decisions? And you'll be shocked that most of them will not charge you anything. They will appreciate that more than if you are coming to them to ask for a loan, because they would want to empower you so that you can be independent like them, not you always coming to ask for money from them or financial assistance from them.
Interesting. Talking about accounting softwares, what are those? How important is it to use them? And can anybody use them?
Accounting softwares, I've seen like with as the business, either when it's starting or when the business starts to grow, there is a need for whichever stage you can afford to have an accounting software in place so that all the transactions that you do are captured in a software somewhere. And with some of the softwares, they're so good that they can actually print you actual reports, which are your final statements, financial statements, like balance sheets, profit and loss statement. You can actually see all those just by a click of a button. So you know as you enter your transactions, all transactions are captured. And the other good advantage is that some of them you have them daily in a cloud backup, you can have an online backup that even if your computer crashes, even if whatever happens, your goods get stolen or there's fire or floods, whatever that can damage your computers, unlike saving in a spreadsheet or an Excel document, you can have that information permanently there in a server out there, depending on which software you are using, whether it's an online version or an offline version. So it is important to have them and to get genuine products and to have proper training in actually using them and maximizing their benefits. All this information about cash flow, positive cash flow, surplus or deficit, it will be able to give it to you whenever you need it.
All right. And then I think the last question that I have for you is about business loans. How does a business qualify for that? And is there a particular time when it's best to get a business loan?
I would say every business qualifies for a loan depending on the idea and depending on who you are proposing it to. You can have a startup business getting a loan and have a business that has been in the market for the longest time being rejected. But depending on the idea and maybe even the people behind the idea, that where do you come from? What is your experience? What is your market research? What are your projections saying? It has everything to do with the decision that whether you're going to be approved or not approved. But for businesses that are running, keeping a positive cash flow is the best hack in getting a loan. If a bank can see your track record of consistently having money coming in and having something remain at the end of the month, and that remaining balance keeps on growing month after month, that is one thing that really would convince a financer that this person, they are able to keep $1,000 every month, which means if you give them a loan that is worth $500, they can be able to sustain it. If your growing balance is growing by 1,000 every month, it shows that you have that positive cash flow that can cover a $500 loan. So it's really about maintaining a positive cash flow for existing business. And for business that are start up, is not, I would not normally advise them to immediately seek out a loan to start up. You start somewhere, you start with what you have, and you grow bit by bit, you grow step by step, and create that positive cash flow, test the idea, because sometimes you can go and get money and put in an idea that the market is not going to accept, or you are not going to drive it for the market to accept it and gain that market share. So it is best that you try out the idea at your own capital, and then when you see that it has potential, that's when you can risk with someone's money, knowing that you're in a position to return it.
All right, that brings us to the end of our session today. Thank you very much, Mr. Senwelo.